Hello everyone. Let's continue our discussion for chapter 10 about liabilities, and now we're going to talk about pensions, which is the last part of the payroll liabilities. So what is a pension? A pension is a cash payment to retired employees. So after people retire, they need some kind of way of getting cash so they can survive. So pensions or pension rights are accrued by employees as they work, based on the employer's pension plan. There are two basic types of pension plans that are defined contribution plan, and the other one is defined benefit plans. So try to remember these two names, and we'll try to explain them briefly, like understand the difference between what's defined contribution plan and what's defined benefit plan. So defined contribution plan is going to be more widely used nowadays compared to the good old days. So in a defined contribution plan, the company invests contributions on behalf of the employee during the employee's working years. So normally the employee and the employer contribute to the plan. So usually the employer tries to match what the employee is contributing. So one of the more popular defined contribution plan, and I'm assuming maybe some of you heard about, is something called the 401k plan. So under this plan, employees contribute a portion of their gross pay to investments such as mutual funds. So it's a long-term investment, and the employee would contribute towards this plan, and typically the employer would match this contribution to a certain limit. So a 401k plan offers employees two advantages. The first thing is that the employee contribution is deducted before taxes, so that there are tax benefits. And the other thing is the contributions are related earnings, and which are not taxed until withdrawn at retirement. So the contributions and the related earnings, you don't get tax on it until you start withdrawing in retirement. So typically if you are investing in mutual funds or a stock market and there's some kind of related gains out of your investment, usually you have to pay taxes on your, what we call it, capital gain. But in the 401k plans, any kind of capital gains are deferred until you start withdrawing your retirement. And at that time, you start paying taxes as if you are getting an additional salary or something. So defined contribution plans assume that, let's see this example, assume that Heaven Scent Perfumes company contributes 10% of employees' monthly salaries to an employee 401k plan. So assuming 500,000 of monthly salaries, again, that's not just one employee, it's for a lot of employees. The journal entry to record the monthly contribution would be as follows. So we are going to debit pension expenses, which is an expense for the business, and we credit cash. And again, for pension expenses, since it's an expense, it goes on the debit side. They're paying the cash because they are getting it to be invested, so cash is on the credit side. So I think it's a pretty straightforward journal entry. We have a brief note here that says it's 10% of the monthly salaries to pension plan. On the other end, we have the defined benefit plans. And in a defined benefit plan, this is the traditional kind of retirement plan where the company pays the employees a fixed annual pension based on a formula. The formula is normally based on such factors such as the employee's years of service, his or her age, and their past salary, their last salary. Sometimes it's the last year, last couple of years, and they get an average of that, and that would be their salary. So in a defined benefit plan, the employer is obligated to pay for the employee's future pension benefits. So they create a fund. And the pension cost of a defined benefit plan is debited to what we call it pension expenses. The problem with that is usually employers, they don't pay enough in some cases, and that leads to what we refer to it as unfunded pension liability. So when we record that, cash is credited for the amount contributed or funded by the employer, but any unfunded amount is credited to unfunded pension liability. So I like to call that is like a form of procrastination sometimes on behalf or on the side of the employer, because sometimes they feel, oh, there's no need to make the contribution now because it's not going to be used. So sometimes it's unfunded or underfunded. So let's see this example. Assume that the defined benefit plan of Henkel Company requires an annual pension cost of $80,000. So the annual contribution is based on estimates of Henkel's future pension liabilities. So on December 31st, Henkel pays $60,000 to the pension fund. The entry to record the payment and the unfunded liabilities as follows. And again, here there are some calculations, but usually the employer would not pay all the pension expenses because it's not as urgent as in the other defined contribution plan. So in this case, the journal entry would be again debiting pension expense, crediting cash, and any amount that is not paid as part of the pension expense is going to be recorded as unfunded pension liability, which is a liability account. So post-retirement benefits other than pensions. Many businesses, they still want to help their employees after the retirement by other forms other than just the pensions. So of course they pay them the pensions, but they want to provide them with other benefits. So employees may earn rights to other post-retirement benefits from their employer. Such benefits may include dental care, eye care, medical care, life insurance, tuition assistance, tax services, and legal services. But again, it varies from one employer to another. These are by choice. It's voluntary. It's not something that's required by businesses, but it's a way of trying to encourage employees to work for the company and stay for a long time. So the accounting for other post-retirement benefits is similar to that of defined benefit pension plans. The financial statement should disclose the nature of the post-retirement benefit liabilities. So I think that's all what you need to know about pensions. We're not going to go in much details about how it's paid later on or anything like that, but at least you just need to get to understand there are two different types of retirement plans or pension plans. Now let's talk about installment notes, which is another important part of liabilities. So what is an installment note? It's a debt that requires the borrower to make equal periodic payments to the lender for the term of the note. So very similar to like mortgage payments and car payments when you finance your car. If you're buying a car and you're financing it, you're actually paying installments. And again, for mortgages, when you buy a house and you have a down payment and the rest of the house payment plus interest would be very similar to installment notes. So each note payments include two things: a payment of a portion of the amount initially borrowed, which we call it the principal, and the other part is the interest on the outstanding balance. So at the very beginning of like the debt, usually you're paying a big portion in terms of interest because the outstanding balance is high. And towards the end of the life of that debt, when the outstanding balance gets to be smaller, the amount of interest would get to be lower. So at the end of the note's term, the principal would have been repaid in full. That's the main thing. But over the time, you keep paying interest, and the interest is usually very high at the very beginning of the life of the debt, and it gets to be very small at the very end. Installment notes are often used to purchase specific assets such as equipment and are often secured by the purchased asset. So again, in mortgages, like the debt is secured by the house. So if somebody does not pay their mortgage like 3 months in a row, then the bank has the right to foreclose on the house. So let's talk about the issuance of the installment note. So when an installment note is issued, an entry is recorded by debiting cash and crediting notes payable. So let's see an example. Assume that on January 1st of year 1, Lewis Company issues the following installment note to City National Bank. So the principal amount of the note is $24,000, the interest rate is 6%, the life of the note is 5 years, and they did the calculation, which we don't need to worry about it for now, and turn out the annual payments are $5,698. And by the way, if you multiply $5,698 by 5, it's going to be more than the $24,000. Okay, I think it's going to be close to $26,000 or even more. So the difference between the 24 and the total amount of payments is what the interest you're paying. So let's see the journal entry at the time of issuance. And at the time of issuance, we don't need to worry about interest. It's because we didn't incur any interest yet. So it's the main focus is just on the principal. So the journal entry is pretty straightforward. We received cash, so we debit cash for $24,000, and we credit notes payable for $24,000. Again, notes payable is a liability that's increasing, so it increases on the credit side. Now let's talk about the periodic payment related to that note. So the preceding note payable requires Lewis Company to repay the principal and interest in equal amounts or equal payments of $56.98, which begins on December 31st of year 1 for each of the next 5 years. So the installment note payments include an interest and principal component. I want you to remember, the interest is usually very high at the beginning of the life of the note, and then gets to be smaller at the very end. So the interest portion of an installment note payment is computed by multiplying the interest rate by the carrying amount or the book value of the note at the beginning of the period. The carrying amount, the book value, is basically the outstanding balance of the note. Because remember, we are making annual payments, and part of the payment is for the principal. So this outstanding balance, or the book value, or the carrying amount of the note, would keep going down. And because it keeps going down, the amount of interest over time will also keep going down. The other portion of the installment note payment would include the principal portion, which is the payment computed as the difference between the total installment note, which is I believe it was $56.98, minus the amount of interest which would keep going down over time, and the amount of payment devoted to the principal would keep increasing over time. So let's see this on the table. I think it would make more sense. So here we have the 5 annual payments that we need to make for year 1, year 2, 3, 4, and 5. And you can see here that the carrying amount was $24,000, which is the value of the note, $24,000. We have regular cash payments over the 5 years. So it's, as you can see here, it's $56.98. And I was undervalued here, like it actually turned out to be the total payment $28,490 compared to the $24,000. So the difference, the $44.90, is the total amount of interest paid during the 5 years. So during the 5 years, you're paying $44.90 for the amount that you're borrowing, which is the $24,000. So how we calculate the interest expense for the first year? It's very simple. We take year 1, $24,000, we multiply it by 6%, and that would give us $4,040. We take the $56.98 and we deduct the $14.40, and that would be the amount of decrease in the notes payable, or decrease in principal. So you can see here that we made a payment of $56.98 or 98, and the amount of interest was only $14.40, so whatever is left, so column B minus C, is the amount of decrease in notes payable, which is $42.58. So now our principal would have to go down from 24 to $19,742, which is the difference between the $24,000 and the amount of decrease in the note payable, which is, again, so in easier way to think about it, column D is column B minus C, and then column E is column A minus D. So now this $19,742 would be the beginning carrying amount for year 2. Again, remember, we're making annual equal payment. The payment is not going to change. The only change is the allocation between interest and principal payment. So the $56.98 is the amount that we're going to pay every year. So we take the $19,742, multiply by 6%, which is what we have here between parentheses, and that would be $11.85. So you see here the amount of interest went down from $14.40 to $11.85 because the carrying value went down, or the outstanding balance went down. So we subtract $11.85 from the $56.98, and that would be the amount of reduction in the notes payable. Then you subtract this amount of reduction from the carrying amount at the beginning of the year to get the carrying amount at the end of the year. And then you move it forward and you keep doing this, and it should reach a very end, at the very end the carrying amount should be 0. Sometimes because of fractions, the number might not be 100% accurate, so if we multiply 6% by 5374, it might be slightly different from 324. But we have to rounded to bring the carrying amount at the very end to be 0. So when this happens, we actually paid the note in full, and we also paid our interest expense in full. So every year, the journal entry would be slightly different because the amount of interest expense would be different, and the amount of reduction in the notes payable, which would be debited, would be slightly different. But the cash payment on the credit side would be always the same. So let's see this in the journal entry. So the entry to record the first payment on December 31st of year 1 would be as follows. The interest expense is $1440. And how did we get this? From the table that we created, it's $1440 here, which is basically the carrying amount at the very beginning multiplied by the 6%. So that is $1440. Then we go to the cash and record it on the credit side because we're making payment here, installment payments. So it's $56.98, which is going to be fixed. It's not changing from year to another. And then the note payable would be a plug-in amount. By plug-in amount is basically the difference. It's just something to make the debit and credit balanced. So the note payable on the debit means we're reducing the notes payable. So it's $42.58, and now the debit and the credit are equal. The entry to record the final payment. And again, you can do this for every single year, but again, let's jump to the last year, and it's the same thing. We have interest expense of $324. And where did we get it from? It's the interest expense here, $324 in the table. And then we record the cash for the full cash payment, $56.98, and then notes payable would be the plug-in amount, which is the difference between these two values, the $56.98 minus $324. That would keep the debit and the credit side equal. So after the final payment, the carrying amount of the note should be 0. Remember that. The carrying value of the note is 0. There's nothing to pay any longer. So which indicate that the note has been paid in full. Alright, so let me stop here. In the next video, we'll talk about contingent liabilities.